Hey everybody, thanks for sticking around. My name is MacLane. This is my co-conspirator Michael, and we are going to talk about a project we've been working on for a few weeks called Lending DAC. Basically, it's a decentralized lending network, and sort of our grand version for what it could be is a little bit different kind of from what we're targeting initially, but you could see something like this, cross your fingers, hopefully be sort of this alternative credit framework to what there is today. So the sort of low-hanging fruit problem we're tackling right away is if you go to these P2P lending platforms like Lending Club, Prosper, BTC Jam, there's a fundamental mismatch in supply and demand. So when a borrower is listed and their loan gets listed, you browse through it. A lot of those are snatched up in minutes. They're funded a lot of times by sort of big financial institutions, hedge funds, and some of the more aggressive banks. Another issue with these platforms is the secondary trading is very illiquid. If you purchase a note on Lending Club, it is possible to sell it before maturity, but you're going to take a pretty significant haircut on that transaction. And then another kind of indirect thing that our network accomplishes is we think it could have the potential kind of minimize a little bit of the volatility of a lot of the cryptocurrencies, given that they're all sort of supply and demand currencies that aren't backed by any other assets. So basically what we're doing is creating this global decentralized lending network that lives inside of Ripple or Stellar or an equivalent kind of currency exchange protocol, meaning that we can push out loans in any sort of arbitrary currency, whether it's USD, Bitcoin, renminbi, or any supported currency on the platform. And sort of the whole network runs on something we're calling Loancoin, which is an asset-backed income-producing cryptocurrency. So basically the way it works is if you're an investor or a lender and you want to invest into the network on the platform, you will send us Bitcoin or USD or any currency that we accept, and you will receive Loancoin in return. And Loancoin basically represents a claim on the underlying pool of capital that lives inside the network and the subsequent loans that are made by the network to end borrowers. And also you can sort of, the parent Loancoin just represents all the loans in the network. It is possible to get sort of more specific asset exposures through child coins, which we'll talk about later in the presentation. And then on the flip side, on the borrower side of the market, obviously you have sort of this access to this new pool of global investors for your debt financing. So I'll just pause for a second and sort of talk about our name, because Lending DAC might not be clear what DAC stands for, but this is the new idea of decentralized autonomous corporations. And basically, it's the idea that these are not legal entities, so there's no central company, but they're still for-profit networks. And it's basically the idea that the value of a network is sort of backed by the services that it performs. So you could think of Bitcoin as a DAC in some ways. So you would say the service that Bitcoin provides is basically transactions and value transfer. And so in Bitcoin, in this framework, you would think of the miners as the employees of the network. They provide a service, they secure the network, they basically mine new Bitcoin. And then the coin holders is kind of non-voting shareholders. One of the problems with Bitcoin is if you look at it under this framework, it actually loses a whole lot of money. But the idea is that in the future, DACs will sort of try to maximize the spread between the value of the services they provide and the cost of actually running the network.
All right. So how would this work? So firstly, this is how normal peer-to-peer lending works. Investors invest money, right? And they get, in exchange, they get some loan asset, which basically says how much interest and principal do they get, and over time they get principal and interest. So on our platform, investors buy Loancoin, and the Bitcoins or US dollars or whatever currency it is gets invested into borrowers' loans, and as borrowers pay back principal and interest, investors get paid with Loancoin itself, and the money are reinvested, right? So if you just buy Loancoin and you hold it, your amount of money will increase over time because the money gets reinvested. And you can go and sell this Loancoin on the exchange, or you can go to our website and exchange Loancoin into current underlying assets. So you can go back to this situation. And right, but for usual buyers of Loancoin, it's easier just to sell it on the exchange, so you can just spend it as a currency actually. Right. So in this situation, we are loan officers, so we select which borrowers are good and which are not. And this is probably not a very scalable solution. So, and this is how we scale that. So we create a network with more nodes, and each node basically selects which borrowers are good, right? And we create trust lines to these nodes, to these loan officers, I would say. And trust line is basically how much money do we trust to invest into loans selected by this loan officer. So this loan officer gets money from selecting good loans, but if his performance will be too bad compared to the system average, he will be penalized from that. So the loan officer posts some collateral in Loancoin itself. Right, so the loan officer invests into a Loancoin. This collateral is an investment in itself, and he selects good borrowers. If he is good at it, his profits will be even higher. And if he is bad at it, well, then some of his Loancoins will go and cover the losses. So this will sort of this will filter good and loan officers from bad ones. And loan officers can have trust lines between themselves. So instead of investing into borrowers, loan officer can invest into the other loan officer who invests into borrowers. So it's sort of a mesh network. And this way, I think, it's going to be much more scalable. But we will start from something much more simple. So the more simple thing is just this. So it's us. We will firstly invest just into the peer-to-peer loans on BTC Jam, which is like a peer-to-peer lending platform in cryptocurrencies, and we will issue a Loancoin for those loans. And this is just to start the system, create the first node, test the ways how we can select the borrowers, and then we will build all this network attached to us. And after that, this network becomes decentralized. So it doesn't rely on us being here. It's just a network of all the nodes. Each node can issue its own Loancoin, by the way. So let's say if this node corresponds to some emerging market, like, I don't know, like India, so it can issue a Loancoin for loans in India, that's fine. And since it's all done in cryptocurrencies, it can go global. So yeah, so this is like a reworking how banking works. All right, and of course we have some challenges.
Sure. So where we are now is we're sort of still working through kind of legal regulatory aspect of stuff. The early conversations we've had with legal counsel have been pretty optimistic that one way or another, we would achieve this in some form or fashion. We may have to register with the SEC or ask for a no action letter, but we are making progress on that point. We have issued sort of a toy version of, a centralized version of Loancoin. We haven't started selling that yet publicly. We're still sort of marking the check boxes from a legal aspect, but hopefully we will be able to start rolling that out and do a limited public crowd sale in the next couple weeks. And that's sort of the main roadblock right now.
All right, and here is information about us, and that's it.
Yep. Thank you.
Any questions?
I was just wondering, do Loancoin holders have any visibility into the borrowers or the loan officers so they can assess some element of risk, how risky those loans actually might be?
Sure. So you have total visibility into loan officers. you may or may not have visibility into the end borrowers depending on kind of what a particular loan officer elects to publish that information. So the way the network works with loan officers is based off of consensus. So the network will say, we trust this loan officer who's been working with the network for a long time, he has a good track record, much more than we trust, say, this new person who just started. So they'll give him basically a higher, for lack of a better word, credit line. He'll have to post less collateral, whereas a brand new person may have to post a high amount of LoanCoin collateral as they build up their sort of track record and prove out their performance. And so, if say you had a bad actor that joined the network as a loan officer, it would be very difficult for him to just take money from the network, give it to his friend, and just run away, because he would have to post collateral in LoanCoin, and that would immediately get sucked back into the network.
So you kind of mentioned some of the legal aspects, and I imagine that can be pretty gnarly. Are you guys considered money transmitters, and how do you kind of fall in that area?
Sure. So we're still talking to lawyers and trying to figure out exactly what types of licenses we need, what, if any, registrations we'll have to do. We may fall under a money transmitter law, and sort of that's a lot of that's in flux right now, especially with cryptocurrencies. If you follow the space, BitLicense in New York is the first sort of draft of that was sparked kind of pretty negative reactions. Hopefully that will be scaled back. On the good side, it seems the SEC's interest in kind of regulating cryptocurrency stuff so far has been pretty limited. Obviously that could very well change in the future. And also BTC Jam, which is a peer-to-peer lending network, very similar to kind of Lending Club that runs in Bitcoin. They basically are, as far as we're aware, not registered with the SEC. They are sort of making the claim that their loans, since Bitcoin is considered a commodity itself, they're taking the position that, hey, these loans are also, these are like a commodity loans. So that may be a losing argument in the long term, we'll see. But we're sort of tracking that pretty closely.
Yeah, so actually, if we do follow this argument, then our LoanCoin will be a commodity pool rather than a security. But if it is true or not, it remains to be seen. So that's what we are clarifying. Not yet.
Are you going to be a U.S. company? Are you going to be a U.S.-based company?
Most probably, yes.
I got a question, hopefully. Is that all right? So to simplify it, is it like you guys are just giving investors access and liquidity to credit, essentially?
Effectively, yeah.
Okay.
To fixed income.
And what do you think? I think you had on one of your slides, like starting off, you essentially need sort of size to get access to credit, but you need that size from investors. So it's kind of like a little bit of a mini market. How do you guys sort of gonna?
Yeah, sure. So this is, I think, was this slide?
No, I think it's the next one. Where it's like initial liquidity.
Okay, yeah.
Borrows, yeah.
Sure. So
Just curious.
obviously at the beginning, when you're trying to bootstrap the network, you're starting out with a limited capital pool, and so the secondary, particularly the secondary sort of aspect of LoanCoin, trading out in the secondary markets is not going to be very liquid because you may not have a ton of people that are even aware of LoanCoin in the first place. So yeah, that'll be something that sort of comes over time. The good news is, sort of with primary liquidity, on BTC Jam, you can invest very, very small amounts and still get a fairly diversified portfolio. So that's, but yeah, that's definitely something that we'll have to figure out.